Good morning. My name is Phil Grandy, philsgang.com. Welcome to my YouTube channel, where I'm going to give you the answer that you want to know. What is the market going to do? Okay. I told you yesterday the market was going to be very volatile. Oh, and by the way, please, during my presentation, would you hit subscribe, like, and share? I would really appreciate it. Okay. And also, on November 12th, you can sign up for our webinar between 12 and 3 p.m. Now, if you can't be there, it's archived for 2 weeks, and a wonderful time to have a class on how to handle this market. It's only $99. Go to my gift shop and you can sign up for it. Also, don't forget, you can join the gang for 10 days free, my gang, okay, for 10 days free if you want. All right. So yesterday what happened is Powell comes out and the first thing he says is, well, guess what? Okay, we're going to cut things back, even starting by maybe the next meeting in November. We'll start cutting rates back. Wow! Market goes up 400 points. Then he came back and corrected himself. Well, I should have said that. We're going to really have to keep rates going up, and we're going to keep doing the 75 basis point. Oh, people went nuts, right? Get me out of the market. Get me out of the market. 1,000-point swing up and down. So the market, remember, the market is going to go much lower for two reasons. He had his opportunity in 2021 when the Fed fund rate, that's the rate at which the Federal Reserve charges their banks, okay, to borrow money from them, and then your bank, based on that interest rate, charges us when we borrow from them. So in 2021, the Fed fund rate was only about 2.25. That was the time that he should have went in and kept raising interest rates on that Fed fund rate to stop demand. See, the way you stop inflation is you stop consumption demand. You do that by raising the Fed fund rate, which affects car loans and everything else. Well, he didn't do that. He didn't do that. So what happened is he let inflation continue to run. And then when Biden got in, inflation really got bad because, again, of all the things you know, okay, he went from being oil independent to where now we're oil dependent. Then he got us into the war with Russia and Ukraine, and that made inflation go up because they control the natural gas over there, and oil, and that's going crazy. So everything happened when Biden got into office. Everything blew up. So he had a window of opportunity, Powell, in 2021 to break the back of inflation. He didn't. So he runs over to Jackson Hole, Wyoming on August 2022, telling everybody, hey, I got to do whatever I have to do to get this inflation down, cut this inflation. And that's why it was crazy yesterday when he came out and he said in the beginning he possibly would start cutting rates at the next meeting. That didn't make any sense. And then, of course, he corrected it. So the market is going to be volatile here between now and Election Day, okay? And so it's going to be, very volatile, all right? But remember, the market's been volatile ever since 2020, beginning 2021. The end is 2021, beginning 2022, because we're stuck in a downtrend channel, and you can't get out of that channel. Okay, not until he breaks the back of inflation. You're not going to get out of it because no one cared before, because as long as they kept pushing money into the stock market, call it QE, and keep interest rates low, hey, they could keep rallying the market. That's over with. He's got to break the back of inflation. That means he's got to break the back of you consuming. He doesn't want you to consume. He's got to raise those rates to 5% because he needs you to get a layoff. That's right. He wants you to be laid off, so that would make sure you don't consume. And so everybody's paying for his mistake and for Yellen's mistake in lying to us and saying it was transitory. Inflation was transitory when it was not. So as a result, we're going to see the market continue to be volatile between now and Election Day. You're going to see the market, long run, continue to go lower, okay? You're going to see it continue to go lower. And that's why you should learn how to sell short. So that's it. So that's will answer your question. What's the market going to do today? Be volatile. It's going to be volatile right up to the election. But overall, the market's going to continue to go lower because values are too high in the stocks. Institutions won't pay for stock. Remember, institutions are the one that drive the market. They buy all the stock, not retail customers. They're not going to keep paying these kind of prices for stock when they're overvalued, so they're not in there buying. Okay, the retail customers running for the hills, so they're not there. Volume's dropping, so the market's going to keep going lower. That's simple as it is. Okay, but we'll keep getting these short covering rallies, though. All right, and you can take advantage of that. That's why you should take advantage of my 10 days free at Phil's Gang, so you can learn how to execute stocks shorting and execute stocks buying. Okay, hey, that's about it. So I hope that helped you. The best thing, keep looking at the Fed fund rate. Never mind the 75 basis point. The Fed fund rate is what you got to watch. He keeps raising that Fed fund rate, and he will towards that 4 or 5%. Market's going to continue to go down. That's what you watch to find out which way the direction the market's going to go long term. Okay, short term, you look at the 10-year Treasury yield. All right, remember, yields go up. That's because the bond market, okay, is no longer getting crushed. Okay, when the bond market gets, the bond market's getting crushed. So what happens? Yields go up and the market goes down. When you have the bond market not getting crushed, okay, where people shift out of stocks into the bond market, then you start seeing yields coming back down and the market going up. But right now we're in a situation where yields are going to go much higher and the market's going to keep coming down because the bond market's in trouble. All right, see you on the charts.